Hello everyone. Let's try today to knit together some economic concepts, some basic concepts which may be useful for us to understand and appreciate managerial economics better. We start by looking at how do firms grow. Firms can grow by growing parallelly, horizontally we call it, or it can grow vertically by going upwards or downwards depending on how what the firm looks towards. We call it forward linkages and backward linkages. Diversification is when you explore into new markets. So let's try to look at these in detail. Horizontal growth occurs when the expansion of the firm is at the same stage of production, but there is a mass increase in the volume of production by taking over another firm, for example. Like say a brick manufacturer who makes 1000 bricks decides to buy another manufacturing unit of brick with another 1000, so that now the capacity with him is 2000. He has horizontally grown the same product, more of it. In vertical growth, we are looking at expansion of the firm up the value chain or down the value chain. We incorporate more than one stage of production process. Let us say this brick manufacturer goes and buys a plot of land which has clay, or he buys a truck which will bring that clay to his factory, or he goes out and opens a retail showroom where he displays his bricks, and that is a sales depot for a brick manufacturer. These are vertical growth. It can be forward linkage or it can be backward linkage. Example of horizontal growth is you have seen in recent times you have had State Bank of India take over State Bank of Travancore, State Bank of Hyderabad. They have grown. It's the same banking business, but it has acquired. Vertical growth occurs. A very good example is that of Reliance. When it went backwards, it went from manufacturing textiles in 1970s. It had Vimal brand. Now that brand is not in vogue, but they have gone in from textiles to, they went into polyester fiber, they went into petrochemicals, they went into petroleum refining, and then they went into exploring oil fields. So you're looking at vertical growth where the linkages are backward from the final product towards what origin of where the source comes from. So that is vertical growth. Can be forward or it can be backward. And then you have diversified growth, where a manufacturer can go into, a brick manufacturer can go into fisheries, he can go into textiles, jewelry, or cashew industry, or you can grow into other new markets, like you can grow into another new state, or you can grow into another new country. So this is diversified growth. Now, what are the limits to a firm? In the case of a firm which is innovative, limits to vertical growth can be immense, like Reliance proved it. But then not all firms are Reliance. So some firms may like to do things best for themselves and leave some of the processes to outside firms. Many car companies buy from the market some of the products which they fit into the car company. They see that these orders are made to their standards. So make or buy decision are the limits of a firm depending on their abilities to do so. In horizontal boundaries, the firm depends critically on two concepts which are very key: economies of scale and economies of scope. When we talk in terms of economies of scale, we are talking in terms of size. We are talking how much of the total product will this firm serve. And when we talk in terms of economies of scope, we are looking at what are the advantages of making a number of products, a variety of products and services this firm will produce. Let's look at more. And then there is a concept of, apart from the economies, there could be also diseconomies. So let's look at those. What are the economies of scale? Economies of scale in simple terms means big is bountiful. It means that the average cost will come down if I increase my production. So as I become bigger, the costs will become lesser. So if I am Big Bazaar, I can buy from the market at cheaper rates. If I am Lulu, I can buy from the global market at cheaper rates. Now, if I am Lulu or Walmart, I will perhaps have costs of fund lower than the Kirana or the small shop. Why? Because the bigger the size, the lesser the risk for the lender. So the lender may give him less interest rate. So his costs come down. And then there may be people willing, like suppliers would like to have shelf space with Lulu or more, and then they will give them credit for longer. Those reduce costs. And then there could be sales promotion efforts are also easier. Malayalam Manorama or Times of India will give better advertisement rates to bigger firms like Reliance because they know that huge advertisements come out, like Colgate. So you will find that those are easier sales promotion efforts if you are a larger company. Economies of scope, when there are two, it is cheaper to make the same two different products, in the same firm than if you go and make two products in two firms. Then we have got economies of scope. Two different products in this under the same roof. So you are looking at economies of scale. When does and economies of scope? When does diseconomy occur? Diseconomy occurs when you become inefficient as you become big. For example, if you are looking at a case of where the organization entity has become so large that it's inflexible, it's bureaucratic, the coordination costs are large, and then the average costs will become higher as output increases. That's not the intention. So economies of scale and scope and diseconomies of scale are important for us to understand. A final concept which I'd like to leave with you is the opportunity cost. When we are talking in terms of an opportunity cost, we are talking of the cost of a choice that we made. When we make a choice, there is a next best alternative we have forgone. There is a cost to be measured in terms of the best alternative that is given up. The next best alternative that I have given up. It is the sacrificed alternative that I have given. And therefore, it adds to my costs. It may add to my costs. Let's give an example. If a manufacturer of bricks can also make tiles, he can decide to make 100 units of bricks or 200 units of tiles. Then the opportunity cost of one brick is 2 tiles, because he decides only one of these two is possible with his grinding mill or puck mill as they call it. You can make either 100 units of bricks or you can make 200 units of tiles. You can decide whichever way you take a managerial decision, where you think can sell better, you can make bricks or tiles. But you cannot make both, and that is the important thing. Now, there is a cost. Now, you have an opportunity cost in coming to study. When you come to study, you pay a certain fees to the institution in which you enroll. Now, you may have given up that money. You could have deployed somewhere and got an interest for it. And that is the costs that you choose. The opportunity cost. The measurement of opportunity cost in terms of the best alternative forgone. This is important in economics because economic costs are the sum of opportunity costs. You have to pay to your suppliers in money terms. So that payment is explicit. But there is also an implicit cost. When the firm's owner has opportunity costs, if he has invested capital, he could have earned elsewhere. That is an opportunity cost he has forgone. That is an implicit cost. When he is exerting himself in setting up his firm, there is an opportunity cost. There is a cost to his exertions. So that opportunity cost is a part of the economic cost. So economic costs are the sum of the opportunity cost of what the firm owner sacrifices, the money that he gives explicitly to suppliers, and what he gets in return for his efforts, as against what he could have got elsewhere. Thank you so much.